Welcome to Smith Weekly Discussions, an occasional program for our readers and listeners of Smith Weekly Research. Please note this program is a private discussion, and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at Smith Weekly, including Matt S., Jackie A., Ryan S., and Jared W. We've got a new guest joining the show today, CEO and one of the founders of Nomad Royalty, Vincent Metcalfe, has joined us. Nomad Royalty is a precious metals focused royalty and streaming company that holds about 11 various stage assets, with 6 of them cash flowing now. The company is listed on the Toronto Stock Exchange under the symbol NSR, and also on the US OTC markets under the symbol NSRXF. Vincent, it's good to have you on the show, and how are you, sir?
Very good, and thank you very much for having me. It's a pleasure to have the occasion to discuss Nomad in more detail on your show.
Yeah, it's great to have you on, and let's kick things off here, Vincent. Maybe your views on the natural resource sector here, metals prices, and any items of caution that you see.
Well, we live in a very, I would say, interesting world and interesting times at the moment. So there's a lot of volatility in various sectors, I would say in the market in general. So from a global resource point of view, I think obviously there's obviously some different revolutions happening in the sense of, you're seeing the EV revolution. So the base metals and the copper demand will, I think, keep growing substantially. From a precious metal point of view, I think with volatility increasing, there is more and more demand from different investors and different, I would say, groups that are looking for a bit more stability in their portfolio. So I think the whole point of having gold as a hedge is being increasingly, being brought forward from the investor community. So I think for both, the base metal front and also precious metals in general, I think we're in a position where over the next, in the midterm, say 2 to 5 years, and then on a longer term, or 5 to 10 years, I think there's going to be substantial demand coming from both markets. So I think it's definitely a good time for investors to be looking at resource stocks at the moment.
Yeah, Vincent, and certainly you follow all of the natural resource sector, with gold and things starting to, I guess the bear market, in gold and copper, and had kind of stopped in late 2015 and really had that first leg up in 2016. And then we had a couple of years there with a little bit of choppy action, and then we've gone higher. What's your thoughts on time frame going forward, and what would you expect given gold's past behavior in past bull markets? What would you expect to see conservatively gold to move to in terms of price in US dollars, and what time frame do you think that'll happen?
Yeah, well, I'm definitely not an economist of any sort, but if you look at, I would say, the last cycle, say if you take the 2005 to 2012-13 period, in times of uncertainties, we see the gold price obviously perform very well. We're definitely in one of those times at the moment. In terms of where the price goes, I mean, in that previous period, we saw the gold price almost go to $2,000 and kind of reset at levels around the $1,400 gold long term afterwards. So I think in our current environment today, I wouldn't be surprised to see gold go near 3,000 and perhaps retreat at, say, a 2,400 or 2,200 long-term level. I think from everything we've been seeing around the world in terms of money printing from the various governments in the world, we're definitely going to see inflation at one point, be a real factor. So I think to that end, I think it's going to help support a stronger gold price going forward.
Last time we were $1,900 in 2011, and it seems that in all the past bull markets for gold, it's always at least doubled. A doubling from its high has occurred in all of the times going back, if I have my history right. So I think it's very conservative to assume that we would see 3,000 to 4,000, and I don't know about higher than that, but certainly I think that it can perform as it has in the past, because if you plug in the extraordinary circumstances that we have, today with money printing and lack of fiscal responsibility and really disrespect for currency. I think that we'll get there. Well, let's go over your background for a moment. Why don't you share a bit on your background, maybe some past successes and failures, and then what attracted you to help start up and lead Nomad?
So I'm a finance background originally, fell into the mining sector when I started a banking career in Toronto back in 2005. And that allowed me to really meet a very diverse group of people and companies. And I think really, the mining world, truthfully, bit me, and I caught the bug. And I think from that point on, really, I knew I was going to be in the mining sector probably for the rest of my career. It's an industry that's full of very, very entertaining and very diverse type of crowds, and they bring you to a lot of different places in the world. And I think from that point of view, I think it definitely expands your knowledge, and you're able to see different parts of the world, and most places that no human being typically go to, in the middle of certain deserts. Or I remember telling to some of my friends, I've been to Mexico about 12 times, never saw a beach. So you end up in these places which are truly remarkable, and you're also able to do truly remarkable things. And the mining sector allows you to go into places and really look at the world in a different from a different lens. You look at a piece of land, and some people see potential for condos, potential for farming and so on. And I think from a mining perspective is you're able to look at a piece of land that you might think is barren, but you do a bit of work on it, you do science, and you're able to actually create real value and tangible value. And I think that's something that really attracted me to this sector. So after about 8 to 10 years of banking, I swapped over to the corporate world, and that allowed me to also kind of have a different view in terms of meeting investors, meeting what and understanding what they want in terms of product. So I would say in the first 8 to 10 years, worked a lot with corporates, kind of structuring deals and doing M&A and equity deals. And then the last 5 or 6 was really more on meeting investors, and also really learning and working directly into the royalty and streaming sector. So, going back to your question, what were the good things, the bad things that you've learned? I think, making sure that you tailor a product that answers what your investor wants. I think that's very important. And also when, we're in the royalties sector right now. So where we think that there's the most, I would say, risk is kind of between that feasibility and construction phase, where typically as you go through permitting, through development, there's that timeline that is usually 2 to 3 years ends up being more 5 to 6 years, because there's so many inherent risks in mining and development that typically these timelines tend to be longer than what the developers believe originally. So where we want to focus on, and where we think the royalty sector has done very well over the last few years, is investing at both ends of those, I would say, phases. So either very early on the greenfield type discovery end of things, or very near cash flow. So when you're almost done with construction, or when you're going through that construction decision, most of those risks have been de-risked, and you're obviously closer to production and cash flow. So I think that's where, from learning and watching the royalty sector, our management team is now in a position to really execute on a plan that we put forward in terms of really, minimizing all types of risks, which, risk in mining take a lot of different forms. So you have, jurisdictional risk, you have operational risk, you have commodity risk, you have, asset concentration type risk, and really maximize 2 things. And that's really the exposure to resources, exposure to commodity. And really that's the beauty of the royalty sector, is that you're able to do these things, and you're able to build a portfolio that minimizes that volatility. So that's why I would think, the main reason why, when we had the occasion of starting a new royalty company, we went forward with that idea.
let's talk just high level capital structure of the company. Why don't you share that with us, and then also the current cash and facilities available at the company's disposal, and then also, Vincent, if you will, the major shareholders here.
Yeah. So as you pointed out, we're the newest royalty and streaming company in the sector. We currently have actually 12 assets now because we closed one last week. So, but we have 6 that are in cash flow. We are 4 months into the trading of Nomad on the TSX. Our 2 major shareholders, from a function of both Orion and Yamana vended in assets to our company. And so Yamana ended up taking about 77% of the shares of the combined entity, and Yamana ended up taking about 13%. As we keep growing this business, and as we keep offering our shares for considerations, we will be diluting them over the years. So at the moment, I would say that there's probably about 90% of the shares that are in the hands of Yamana, Orion, and management. And really, this is really just the beginning. We understand that we need to work on having more liquidity. We understand that we have to work on, increasing the registry of shareholders, and that's something that is very much at the forefront of what we want to do. We are, when we sat down with Orion and Yamana, when we created this company, we told them that at one point we would need them to be offering some, liquidity to the market, to make sure that we had the ability of bringing in the larger financial institutions into our stock, and that it would actually have a positive effect on their shares going forward. Because as we create that liquidity, as we create that interest from the bigger funds, we'll have bigger, stronger support. And one of the main things, when we created this company, we actually priced our deal at 1x NAV. And for those that are, I guess, less familiar with the streaming and royalty business, the royalty business, for years and years now, has been trading at premiums versus the producers or versus the developers. So if you look at where we are today, the mid caps, the producers, they all trade between 1.5x and I would say 3x NAV for the most part. So we have that arbitrage in the sector. So by pricing our deal at 90 cents, and Yamana and Orion taking the shares at 90 cents, we priced that deal at 1x NAV, knowing full well that as we keep executing over the course of the next 2-3 years, that re-rating would translate into the share price. And that's really the philosophy and what we sold Orion and Yamana on, is that re-rating potential, that they would actually crystallize more value over time than just selling their assets for 1x NAV to one of the major companies in the sector.
Can you just cover for us shares outstanding here, and then also your cash and facilities?
Yeah, so at the moment we have about 524 million shares outstanding. We haven't done any rollbacks of any sort. So the shell from the outset had 30 million shares, and then Orion and Yamana took back shares, so that's why the share count is quite high. But from a financing point of view, we only did one financing so far at 13.3 million, which was concurrent with that original deal. However, we did put in a credit facility in place, which is at $75 million US, and is led by Scotia, CIBC, and RBC. And that's very important for companies in our sector, because that will allow us to write bigger deals, and really allow us to look at doing new deals with partners. And that's where, when you look at how the Wheatons of the world and the Francos have done over the past few years, is they've been using their credit facility to buy these deals at around 1x NAV, and then they essentially they get the benefit of the higher multiples at which they trade directly from the market. So that's where you're able to grow exponentially and grow relatively quickly, because you're able to leverage that ARB factor.
when you talk about the, your guys' market cap where you guys are today, and just looking at some of the other companies, we've seen a lot of companies that get in kind of the market cap where Nomad is today. We've seen them jump over, or even actually earlier sometimes, we've seen them come on to New York Stock Exchange, Amex, and get listed. We've seen that recently with Mavericks Metals. We've seen that with Metalla Royalty, and we've seen that with a number of other companies. What's your guys' thought on that? Because you guys are of that size already. Are you guys looking at this kind of a listing sometime in the next year or two? What's your thoughts on that?
Yeah, I think, from the outset, we didn't want to come out. I think the main thing for investors to understand about Nomad, this is going to be a very transactional focused company. So we're going to be doing a lot of deals. And, we've actually gone through the process of listing on the NYSE with our previous company. So we know what it entails in terms of, compliance from a, SOX point of view, from a, just a fees point of view, higher D&O, insurance costs. There's a lot of things that come with that listing. Obviously, there is a benefit of having a stronger, I would say, pool of investors on the US front. So that is definitely something that's in consideration. But I think for the next, say, 6 to 12 months, we're really going to be focused on building the company, and it's just, not being listed on New York Stock Exchange actually allows us to be a lot more flexible in the terms of transactions that we're able to do. And we have a relatively small team at the moment. There's 4 of us. So really the focus is on cash generation to fuel those higher multiples, and really keep building the portfolio out. I mean, we definitely think that the NYSE listing will come, but it's not a focus of ours, I would say, within the next couple of quarters.
Yeah, that makes sense because, the company has only been listed on the TSX for a period of time here. So I think from a timeline standpoint, I think that it would make sense at least a year out from here. We'll talk about G&A costs for a moment. The company has mentioned a goal of having low G&A as compared to sector peers. How is the G&A structured, and what can investors expect on this side?
Well, that flows well into the conversation, as we just kind of covered the NYSE aspects and why we didn't go there, because we want to minimize the G&A costs at the moment. So we, first of all, we chose not to be offshore either. So all our assets were actually brought back onshore in Canada. We did it in a tax neutral way, where we were able to bump up some of the tax pools to alleviate any, I would say, from the transfer of the offshore assets to be onshore. But we believe that going forward, it actually minimized some of the risk associated with offshore businesses now. And from a competition point of view, having been in the business for 5-6 years, we can't say that we truly saw the benefit of having an offshore structure from a competition point of view when we're bidding for assets. So that's why we really wanted to bring everything back onshore. And it also minimizes those G&A costs, because more and more now, the offshore businesses need their own independent management teams. So that means you're doubling every employee and every management personnel. So instead of having four of us, we'd probably be 8 to 10, just to cover that office, because you have to show management teams in those offshore businesses now. You can't just have a postal office. So from a G&A point of view, we want to minimize that as much as possible. We want to make sure that we have, and that translate into delivering more value to our shareholders. So we see the low G&A costs, very much associated with what we return to shareholders from a dividend policy. So the less we pay on G&A, the more we're able to pay on the dividend side of things. And so right now for this year, we're probably looking at cash G&A of around $2.5 million. And I would say that the expected cash G&A for the next year, when we're, I would say at steady state, we're probably between 4 and 5 million. This year, what's even better for investors is that the three of us execs have committed not to take cash salaries, so we're taking shares instead on a quarterly basis, and that's something that we really wanted to focus on, because we want to show the investors that we're fully aligned with them. So whatever is good for us is good for the investors. Whatever is good for the investors is good for us. And that's a mentality, really we want to keep that top of mind for investors, is to aim to have that low G&A cost, and probably one of the lowest costs in the sector in general, to make sure that we minimize those costs for the shareholders and that we focus on returning capital or reinvesting that capital into new investments.
Vincent, what is your position on the cash flow use going forward, excess capital at the company? Do you support dividends only? Do you see that continuing to build the cash balance for new deals is important? Share buyback if the shares obviously are valued correctly. How do you approach these different methods of capital use? What's your view on these different vehicles?
So the dividend for us is very important, and that's why we've already put it in place. Really, I think having a very strong dividend will be very attractive for the investors, and we have the benefit of having marketed a royalty company for 5-6 years, and I would say that the generalist investor is always looking for a dividend. I would say the majority of the time. So when we're building this company, we want this business to be between 3 and 5 billion, hopefully within the next 2 to 3 years. So it's going to be very, very high growth, and we want to make sure that the product that we're building caters to that generalist investors. So having that dividend is very important. In terms of how we size it, at the moment we announced a 2-cent dividend annually, which represents about a 1.5% yield. And really we are looking at building on that. That represents about a third of operational cash flow. It's really a start for us. As our portfolio matures, we would expect to keep increasing that dividend. In terms of the level at which we'd get, it wouldn't be crazy to think that we'd return up to 50% of operational cash flow over time. We are looking to keep increasing our portfolio, so we want to keep some cash on the balance sheet. But as I pointed out before, having that credit facility allows us to look at deals and using that credit facility, and perhaps once we've been able to execute on a deal, show the market what we're doing, to go in the market and refinance that credit facility. So we're not looking at the credit facility as being a permanent part of the capital structure. So we're not big fans of debt, but to use it as an instrument to buy things, that's what we want to do. In terms of buyback, we have a very, very tight float at the moment, so that's not something that we have in the cards. But if we did get to a point at one point where we thought the value was definitely not reflective of our business, maybe we could look at that. But I think that for now, it's not something that we do. We really want to keep increasing that liquidity. So by removing shares of the capital structure doesn't really help us on that front.
Yeah, and I think all of these options should be on the table for use at different times, because I think throughout these cycles of these companies and so forth, I think all of these options become more attractive over the other at different times, but they're all needed. With what you guys have as cash flowing assets right now, what's your thought on, if the deal allows, what's your thought on taking physical delivery of gold and silver and keeping a portion of that also in the company portfolio as inventory? Do you see that there's value in that rather than always being in dollars?
It's yeah, it is. It's definitely something that we've thought about in the past. I mean, we receive our gold all in physical, so we actually do our own gold sales. But it's definitely something that we've thought about. I mean, the biggest competition to the royalty companies right now, in terms of investors, is investors just buying the gold ETF for physical gold. So if we're able to structure a way where we would keep some of that gold on our balance sheet, I think there could be something very creative done here, and it's definitely something that we've thought of in the past. I mean, right now, we're selling our gold, and we want to book the sales to make sure that our investors understand what type of revenue and what type of deliveries we're getting from these various assets, given that we're a very new company. But I think that, again, looking forward, we wouldn't be, it's definitely something that we've thought about, I can tell you that, because keeping that, at the end of the day, the investors coming into our stock want exposure to gold. So if we're able to keep some of that gold and increase that exposure, I think it's definitely something that at least we feel is in line with the investor mentality.
Yeah, I think so, because this is kind of a supplemental value add. And I think as time goes on here, I think it's becoming increasingly important when you have an investor that has the shares, they're realizing that growth in the shares, and but also, if they can see a dividend policy that pays out, or the company decides to hold inventory for their view on gold and silver appreciating, that also can be a portion. I understand cash flow is also needed, but very interesting kind of set of circumstances and some strategy involved there. Talk about the present paying assets of the company. Why don't you just kind of give us just an overview of that portfolio, and also what your expected growth is over the next 1 to 2 years.
Right now, we have obviously a very diversified portfolio for a company that's only been in business for 4 or 5 months now. The important thing for us when we were creating this business was to really focus on having a good proportion of our assets in cash flow. And really the reason behind that is when you look at the valuations of the big senior companies, the more percentage of assets that you have in production, typically the higher the valuation you get. So for us to start with, 90% of our assets on the exploration and development stage was not something that we wanted to entertain. We understand this business. We know it needs cash flow. We know it. You need to control G&A because it's basically an immediate cost. So really for us was structuring a business that had production. So at the moment, we have obviously a few different assets that are in cash flow. We have one in Ivory Coast called Bonikro, which is a mine operated by Allied. We have the South Arturo mine, which is operated by Nevada Gold Mines. We have the Mercedes mine, which is operated by Premier Gold Mines. We also have Guacamaya, which is in production, operated by the Mineros, and Equinox Gold, which is in operation, RDM, the mine, which is operated by Equinox Gold in Brazil. And we also have another instrument, which is a gold loan, which is payable by Premier. And that structure is essentially for the next 3 years, Premier delivers us 1,000 ounces a quarter. So that it's a very interesting dynamic, because we're able to get that very steady cash flow over the next 3 years. And the great thing about that portfolio in general is, as I pointed out, so you've got assets in Nevada, you've got assets in Mexico, Argentina, Brazil, Ivory Coast. It's very diversified. So we actually think that actually gives us a very good portfolio with limited volatility. If you look at the impacts of pandemic had on these assets, the Ivory Coast asset had 0 days of shutdown. The ones in Brazil and Argentina had about 5 days each. In Mexico, we had about a month and a half. So you could see that if we would have been, just, I would say, in Mexico or just in Canada, which when you look at the assets, the operating assets in the mining space that were shut down the longest, the ones in Canada, were the most impacted. And that's where we think, as you grow a portfolio and as you add assets to that portfolio, having a lot of different jurisdiction actually minimizes that risk profile. So that's where we think our, the strength of our portfolio comes from, is having a lot of various assets in a lot of different jurisdictions.
And Vincent, just for the audience, so they can get their head wrapped around it here, on gold equivalent ounces, where are you guys at today, and where do you expect to be, say, in 24 months?
Yeah, so this year is a bit of obviously it's a bit of a stub year, because we created the company back in officially in end of May. So we're looking at, so I'll talk in cash flow in terms of 2020. We're looking at probably $20 to $25 million of cash flow this year. For next year, which would be our first real year, in terms of estimated deliveries, we're looking at about 17,000 gold ounces and around just under 700,000 ounces of silver. So from a gold equivalent point of view, you're looking at 25,000 ounces. And the margins of the company, life of mine, are around 77%. So it's a very, very good business, very high margins, and really, this is, as we pointed out, it's just a starting point. So we have 6 assets which are in production at the moment. We have another 2 which are in construction right as we speak. So we have the Blyvoor mine in South Africa, and we also have the Woodlawn mine, which is actually fully built in Australia, but still on care and maintenance because of the impacts of COVID. We strongly believe that both of those operations will be in production within the next 12 months, which would bring our production profile closer to 75 to 80% in production from an asset stage point of view. So that's really, we think that's going to even, fuel our multiples even higher. It's going to have a very big impact on our cash flows as well. So in terms of that number, the 25,000 ounce GEOs, that only accounts for about 50% of the production at Blyvoor next year. And it's, we think obviously with 77% margins, depending on what your gold price is, in terms of cash flow and operating margins, you're looking at, around $37 to $39 million US. So very significant in terms of cash flow.
Talk just briefly about competition here. As the market heats up, Vincent, the competition between these royalty companies will increase, and for some will result in royalty companies paying up for assets just for the sake of growth. How will Nomad handle these market conditions while keeping the price paid for deals in check?
Well, we have a slide in our investor deck, and people could download it on our website. But there's a royalty sector, I would say, market cap slide in there that shows how it's evolved over the last 15 years. So you've seen a market, in aggregate, which was probably worth around $2 billion in 2004, and at the close of the last quarter on September 30th, it was now worth around $65 billion. So you've gone from 2 to 3 companies now to probably over 20 companies in the royalty sector, and that really, I would say it really shows that this is something that the investors really like in terms of the low risk profile. But what that also does is it means these companies have more and more means to buy things. And really, from a competition point of view, we've been directly involved since 2014 in this sector, and we've never been this busy as a management team as today. There has been a very big shift in terms of how companies now do project financing in the mining sector. So streaming and royalty is now part of the project financing packages of these new mines. So typically, 15 years ago, you would see debt and equity being the only 2 options. Now you have debt, equity, and also typically a streaming portion, which actually optimizes your capital structure as a developer, because that cost of capital is actually lower typically than what debt is, and sometimes equity. So we've never seen this much, I would say, product in the sector, and I think a misconception of certain investors sometimes is they think you have 20 companies in the sector, so therefore if there's a new deal, the 20 companies actually bid on this one thing, which very, very, very rarely happens. I would say that in the 3 deals that we've executed on so far this year, we were either alone or maybe had 1 or 2 more peers that were looking at that asset. So it's all about having a team that has the ability to bring in new deals and have a Rolodex, and that's what really makes the difference for a royalty company. Is, do you have the connections and you have the ability to sit down with a vendor, and which we actually see them as partners, because typically we strongly believe we'll be able to do a second and third deal afterwards with them. So are you able to sit down with a potential partner and really find a win-win solution? So from a competition point of view, there's obviously 8 companies, which we would consider ourselves now a mid cap, and then you have the big senior companies. But on the lower end of things, I would say that the smaller companies don't necessarily have that ability to do big deals like we do, because we have that cash flow and because we have that credit facility, which allows us to go and bid on these things. So I would say from a competition point of view, we actually think the current market is really, well, I mean, it's growing every day, and I think it actually creates more and more opportunities on the monthly and a quarterly basis.
Yeah, agreed. I think we still have a window here where really good value can still be realized before, the bull market gets into the kind of mid and later stages. Now, Vincent, as you know, a number of royalty companies have reiterated their focus on precious metals. As the precious metals sector continues to heat up and margins for potential deals decline as a result of competition later stages, will a company look at base metals like copper, like PGMs, zinc, as a place to potentially seal good value deals while companies on this side remain more in need of capital versus maybe potentially some of the deals that happen in the precious metals side? What's your thoughts on that?
So we're definitely always going to be a very precious metal focused company. I mean, at the moment we're 100% precious metal focused. We have, the ability probably to look at, some other commodities, but it'll never be. I think the most important thing for us is understanding the transparency of the pricing structure of a commodity. So if we were to look at another commodity, it'd have to be some type of LME traded commodity. So I would say that our third choice would probably be copper, after gold and silver. Again, because, in the intro, we discussed the EV revolution, and I think copper and nickel will probably be the two commodities that really benefit from that shift. So those are probably things that we would look at. But in terms of, the bulks or the other battery metals, which are more exotic and have a very, I would say, difficult pricing mechanism, that's something that we won't look at. The benefit of having gold, silver, and I would say the base metals is that every day you have a spot price, and you understand what you're getting into and what type of value you're able to get for that pound of copper or that ounce of gold, versus some of these other commodities. It's more difficult to understand. It's more of a black box type pricing mechanism.
M&A in the sector. Do you see that some of the majors have interest in doing M&A with the smaller companies in the space, or do you see the mid-tier companies making the M&A moves to get into major status?
Well, it's definitely been a sector that hasn't seen much M&A over the last 10 to 15 years. There's been a few new entries, companies that over the years, I would say once every 2 or 3 years, we saw a bit of M&A. Whether the big guys want to buy the smaller guys, who knows? What we could tell you is that Nomad, we want to be in a position to be a catalyst. So whether we end up buying or we merge or we get bought by someone, I think there's definitely a need for a new, I would say, large mid cap. So right now, I think by having maybe a fourth larger player would change things up a bit in the sector, and I think it would allow that new player to be even more competitive versus the larger companies. And I think that would actually be good for the various operators that are looking for financing, because it allows them to have another player to talk to. The larger players have very specific things they're looking at when they're doing deals. So I think by having a new player with maybe a more flexible way of looking at deals could definitely be a benefit. And really, from a mid-cap point of view, by scaling up, you do get closer to the multiples of the big guys. When you look at Franco, Wheaton, and Royal, they all trade between 2.1 and 3.5 times NAV. The mid caps typically trade between, say, 1.2 times and 2 times NAV. So by having that new vehicle and having those passive funds and basically the funds that need to own these stocks fuel that natural buying in your company, you should see a re-rating on the valuation point of view.
Vincent, a few months back, we had China Moly do a deal with, I think it was 550 million, a precious metal deal with Triple Flag, which still hasn't listed yet. What's your thoughts on working with Chinese companies, and will Nomad look to do deals with Chinese companies if the right opportunities come along?
Yeah, no, we saw that deal, and then it was a good deal. It was it's a good operation in Australia. There's definitely some good upside, and the great thing with those types of assets that they have mine lives which are 50, 75 year long. So those are definitely attractive assets for royalty and streaming companies. In terms of whether they're Chinese, or I would just maybe qualify them as private companies. If you look at our portfolio today, we have 3 companies that are private, which are our counterparties. I think it's just you need to do your work on the quality of the management teams within those private companies. Obviously, the North American sector on the mining front, typically, they're mostly all public companies. But when you look at it from a global point of view, there's a lot of private companies and a lot of private groups with a tremendous amount of money and financial means to operate these companies and these projects. So I would say that you really have to do your work on understanding what type of counterparty it is and what type of management and what type of technical team they have. But when you look at the mine at Bonacro, for example, which we own a stream on, this is a team that's been in Africa for years. They built Lumwana for Equinox, which was ended up being sold to Barrick. You've got the Blyvoor team in South Africa, which built Ergo Mines, and the founder actually was one of the discoverers of the mine that was bought by Ashanti in Tanzania, Geita. So these are groups that have a very significant amount of experience in the mining world in their various jurisdictions. And I think that's the most important thing. So if you have a team that understands what they're getting into, that has a track record of, that's what we focus on. And are you in a country where you have a mining culture that is existent? And so that's the way we minimize risks, is we make sure that when we do these investments, we understand those different, we go through the checklist and we make sure that everything is answered properly.
Yeah, I think there are some good Chinese companies, but there's also a lot of bad ones. And so I think it's on a case-by-case basis. Vincent, you mentioned jurisdictions a couple of times here. Is the company open to all jurisdictions, or is there a specific objective for how you guys plan to diversify the company assets?
We are open to most, but we're not open to all. I think, again, going back to what I just said regarding jurisdiction and mining culture, I think that's the main thing is are you investing in a country that has an existing, mining culture? And if that country's nationalized assets, 5 times in the last 50 years, that's probably not something that's, hits our radar. So, but there's obviously places like, the Middle East, the DRC, China, Russia, probably those are areas which we will not be investing in. But if you look at West Africa, yeah, there's been, sometimes there's instability from a political point of view, but how many times did you actually see a mine shut down? And, I would say that it hasn't much really happened. So those are the type of analysis that we do, is we make sure that there's an existing mining culture, that it brings benefit to the community, and that the community wants the project too. So I think that's the things that we really focus on.
Yeah, I think Venezuela probably wouldn't make the list. Now, Robert Friedland would disagree with you on the DRC, but let's take a look. Hopefully you guys can find something in Namibia. I think that's a fantastic jurisdiction, Botswana, and of course you guys, there's some other good jurisdictions up there as well. So Africa has a lot of promise. And as these metal markets heat up and prices get higher, we know that governments in the past can get grabby and change their policies. So we've seen that before. Well, let's move on. Maybe just speak briefly about cost of capital. So when you guys are, right now out there in the market, do you see that the cost of capital is becoming more in the favor of the companies trying to develop these projects, or do you see that the cost of capital is really still heavily in favor of the royalty companies on the other side? What's your thoughts just on cost of capital, some of the traditional lending institutions, policy rates around the world where capital is becoming more loose and rates are declining from a government sense? What's your thoughts on cost of capital here?
We've gone through obviously a pretty difficult period in terms of the gold sector in general over the past 5-6 years. So I would say that, definitely the royalty and streaming companies had maybe much more to choose from and could be a lot pickier. Obviously with gold prices reaching 2,000, and there's definitely been some type of renewed interest for our sector. I still think it's very limited. We've seen only a limited amount of, I would say, significant deal financings happen. So it's still, I don't think that the sector is out of the woods yet in terms of just being able to rely on equity financing from an operator point of view when they're looking at developing new mines. So I still think there's definitely a good way for royalty and streaming companies to invest. And also it goes back to optimizing the cost of capital to the operator. Having a portion of perhaps what would naturally be a debt investment from a bank go into a stream could sometimes actually be much more profitable for the operator, in the sense that the covenants are a lot looser. We are partners. We are, this is a life of mine investment in most cases. So it's when you're talking about a long-term investment, we are the longest type of shareholders when we're investing in these projects. So so we want to make sure the mine operates as efficiently as possible, has the less hiccup as possible. So we are fully aligned with the operators. Sometimes, with bank debt, there's a lot more restrictions on what they can do, what they can't do. Just an example on that. If say you're ramping up on a new mine and, all of a sudden they start drilling an area where they find much higher grade, and they say, from an operational point of view, the operator says, maybe we should go and, drill this out, and maybe it'll be double the grade, and, we'll have a better feed to the mill. Well, if you're a streamer, you're like, yeah, absolutely, let's go there. However, the way that the bank structures are done on the debt front, they're limited to a certain footprint, and you have to execute on the actual plan that you put forward. So maybe that new area which just got drilled, they actually can't spend the money because they have to get the payback, and they have to pay the bank as quickly as possible. So that's where we are much more partners and much more aligned. So there's that. I think that attractiveness of financing through streams and royalties will never go away. Obviously, I think there might be a bit more competition on the equity front, but I think from an optimization point of view and minimizing dilution to current shareholders, I think there's always going to be a place for streaming and royalty for operators. I think now, the last 15 years has proven that there's a lot more interest and a lot more capital to deploy. So I think there's, this is a very new sector. So I think we're just really in the beginning of the sector per se. And I think we're going to see a lot more innovation and a lot more partnerships between the royalty companies and the mining companies.
Agreed. And Vincent, with further capital needs coming at the company as you guys continue to fund your growth strategy, existing cash flows coming in, do you guys see that future deals will be done with cash and credit facilities, or do you also see that some of these deals will continue to see the issuance of shares in order to complete them?
Well, for us, it's really I would say every opportunity we look and evaluate differently. It always comes back to per share accretion. Truthfully, that's the main thing. As we pointed out, the management team is the largest shareholder, single shareholders of the company. So we think as shareholders first as well. We want to make sure that over time we keep growing those per share metrics, and we execute on accretive deals. We're also very conscious that Orion is a 75% shareholder, so we want to make sure that they get diluted over time, and that we create that liquidity that we've discussed earlier. So in terms of the 3 deals that we did so far since the start of trading, they were essentially about 90% all shares, and then small portions in cash. I would say that, but we were able to execute on those deals at very attractive valuations versus where we were trading. So we strongly believe that those were very accretive deals. To write a new stream, if you look at stream financings in general, they get priced between 0.9 and 1.1 times NAV. So if we're trading at 1.5 times and we do these things, we'll realize about half a turn of accretion. So it's a mix. It's really every opportunity is different, but we will want to use our shares, I would say, in specific opportunities, and sometimes we'll use our credit facility and pay cash.
Yeah, understood. Makes sense. And I think you have to look at it on a deal by deal basis for the sake of long-term value. Well, talk about just briefly, the company's mentioned strategic partnerships and teaming up. Can you just expand on that and what is meant here and maybe what an example of that might be, just for purposes of, obviously there's a big goal to work and partner with the companies that are part of your deals, but do you also mean potential teaming up with other royalty companies? What's your thoughts on that, what you guys have said there?
Yeah, so we touched on M&A earlier, which, that's for Nomad and our peers to grow and to catch the big three. In the interim, for us to be able to compete with the big three, we need to have a better access to capital and be able to show that we're able to compete on the bigger deals. Because what happens is, if a company, as you pointed out on the deal that was done on with China Mali on the Australian asset, that was a $550 million check. At the moment, Nomad doesn't have the capacity to write a check that big. So, if we're able to partner up with either our peers in the sector, so other public companies of our size or around there, or if we, what we call the alternative, providers of capital, like the private equity groups and so on, if we're able to partner up with some of those groups, we could potentially have the capacity of writing a $300 or $400 million deal. And what that means is that we're going to be invited in some of those processes, which are sometimes our more strategic type assets. So, but the great thing about doing that is when you come to the end of it, you're able to say, well, maybe I want $40 million of exposure out of this $200 million deal, because we don't want too much of one asset having too much concentration within the entire portfolio. So that's where, by teaming up with other peers, we're able to say, okay, you guys take 100, we'll take 50, the other party takes 50. So we've actually done that in the past. We've done it as even this summer on a few things. We've looked at due diligencing a few opportunities with another partner, and we strongly believe that, I think, from a go forward point of view, it's something that should be seen in the sector, as at the end of the day, our job as managers of a royalty company is to limit those different forms of risks, and asset concentration is one of those risks. So if we end up with an asset that represents 70% of our net asset value tomorrow morning, well, all of a sudden we're subject to whatever happens to that asset is going to impact our valuation, and that's a situation we do not want to be in. So we want to make sure that when we do these investments, it's on a risk-adjusted basis.
Yeah, very good points, and I certainly agree. Let's digress for a moment and talk about how you're investing in your own personal situation, Vincent. So besides being invested in Nomad, which I assume is your largest investment, how are you investing across the natural resource sector? What types of companies do you like personally? And are there some that come to mind in your own situation that you see as highly compelling?
When I look at my personal investments, yes, Nomad is definitely the biggest one at the moment. And I think it always comes back to the same. There's always the management, is definitely always something that's important when looking at investments. I've looked at, there's a company called Champion Iron Ore that's also based out of Montreal, which are doing great things, and the iron ore price is doing very well at the moment. And so I'm sure they will have a good, they're definitely going through a good period. But management team and track records are always the most important thing. And really, I would say being able to understand the actual company and underlying assets that are within that company. Sometimes you go through a presentation and you even after 30 or 40 minutes of going through the documentation, you still don't fully grasp what exactly they're going at. Are they drilling? Are they developing? Are they building? Are they, I think being able to have a very transparent way of understanding what they're going after and what's their deal, that's something that's very important. And what I like to see when I do investments is, within the presentation, is there a slide on things, what did they say they were going to do and what did they execute on, and what was the timeline? Was it 6 months? Was it 12 months? Is it 2 years? Like, are they accountable to the things that they put forward in terms of goals? I think that's something that when you look at the successful companies in the space, they typically go through those, goals and show, did they get there? Did they fail? Or if they fail, why did they fail? I mean, we're in a sector where exploration is not something it's a science. And, sometimes a great target and a great anomaly looks very good on paper, but once you test it, it might have, nothing behind it. So you should be able to sit in front of an investor and say, look, we did our work, we identified an anomaly, we found a few targets, we drilled them, there was nothing. It's fine. We need more of that, but I think we need to be accountable as management teams to really tell the investor what's happening and what's the 12 months in front of us and what's the 24 months in front of us. In terms of Nomad, we're very focused, and we've pointed out before, we want to be part of a platform that's between, say, 3 and 5 billion within the next 2 to 3 years. So how are we going to do that? Well, M&A, partnerships, co-investments. Those are, we know that if we keep going that route, we're going to be able to execute on our plan.
You covered a lot of it here, but just to reiterate one more time, for potential investors in the audience listening, why should they be looking hard at Nomad today over the other peer names in the sector?
We're executing on what we feel is a very simple strategy. We have a team that's been in this sector directly involved for the last 6 years. It's a very steady business plan. The main things that we're focused on is, let's focus on producing assets or highly de-risked assets. Let's make sure we keep a very diversified portfolio. So increase the number of assets, increase the number of jurisdictions, increase the number of operators so that we don't have too much concentration in one specific area. Stay focused on precious metals, so gold and silver in our case. Really focused on low G&A. So that's always going to be, a very strong focus. Return capital to shareholders. So come in with a significant dividend and really keep building on that. And really the main thing is thinking like owners and thinking like shareholders first. So in everything we do, and that means in terms of the investments we do, in terms of the compensation that we pay ourselves, in terms of returning the capital. So it's keeping the shareholder first and really top of mind. Those are the main criteria why I would say somebody should invest in Nomad. And we're a very energetic team, and we have a lot of things to do. So I would say from that end, that resumes why somebody should invest in Nomad.
And how can interested investors reach out to you and the company?
You could reach us through our nomadroyalty.com website. There's actually a link as you open the website, which allows, whether you're a retail investor, institutional investor, or just somebody that's looking to ask questions around the business, you could book us through book a management table, and that sends us an invite, and we'll send you all the details to connect either through the internet platform or through a phone call. So we want to make sure we are as accessible as possible as a management team, and looking forward to meeting any potential shareholders down the road.
Well, Vincent, good discussion. Really appreciate you coming on, and best of luck over at Nomad, and look forward to speaking again soon.
Thank you very much for having me.